Yes, students. Now we will revise the second head of income, that is income from house property. Section 22 to 27 of Income Tax Act contains the provisions with respect to income from house property. Section 22 being the charging section specifies the annual value of the property of which the assessee is owner is taxable under this head. Now, sir, what is property? Guys, under the house property, property means the building. But if there is any land which is appurtenant thereto, that is the land which is attached to the building. For example, sir, there is a land and on that building is constructed. In such case, the income from both building as well as land will be taxable under the head house property. Or else, if there is a land area which we call it as like garden or even parking, even in such case, the income from the building along with the land area will be taxable under the head house property. Sir, what if there is only land which is let out for parking purpose? So if there is any land without building which is let out, then income from such letting out of land will be taxable under the head other sources, guys. Got it? Yes, sir. Then there are few exceptions where the annual value of the property will be taxable under the head PGBP and not income from house property. When is it? I have given the cases here. Property which is occupied by the assessee for his business or profession, then the income from such property will be covered under the head PGBP. And the second one, when the assessee is engaged in the business of letting out of commercial properties, then whatever rental income they are earning will be taxable under the head PGBP. So I have just given a small chart here. Please observe. If assessee is engaged in the business of letting out of commercial properties means, then the rental income will be taxable under the head PGBP as business income. Whereas if assessee is engaged in the business of letting out of residential houses, even though it is in the nature of business, still the rental income will be taxable under the head house property, guys. Got it? Yes, sir. So I have given few notes here. Guys, please be careful. Even though they are using the word annual value here, what is important is rental income. But obviously, rental income will be considered to compute annual income, but along with municipal value, fair rent, and standard rent. Because there can be high chances that the assessee might manipulate in order to evade the tax. So that is why under this head, along with the actual rent, they have also considered municipal value, fair rent, and standard rent to compute gross annual value. Okay, sir. So there are few notes here. Let me read it. This head deals with self-occupied property or let-out property along with deemed to be let-out property. And let-out property for what purpose? Residential or commercial? Guys, don't get confused with this. If the property is let out for residential purpose, no doubt rental income will be taxable under this head. Sir, but what if property is let out for commercial purpose? There also we need to see. Is it in the course of business for the assessee? If yes, then the rental income will be taxable under the head PGBP. If not, for example, I have just had a one shop, I have let it out for a rent, and it is not in the course or furtherance of business for me. Letting out is not my business. In such case, the rental income from letting out of shop will be taxable under the head house property, guys. Clear? If letting out of commercial property is my business, then rental income will be taxable under the head PGBP. No, sir, I have some small shop or building. I have let it out for rent, and letting out is not my business. In such case, the rental income will be taxable under the head house property, guys. You would have seen many building. There will be a residential building in like first floor, second floor, third floor, and all. Whereas in the ground floor, they may have one or two shop. So if they have let out that shop for a commercial purpose, then where the rental income will be taxable under the head house property. And even if they have let out the residential houses, which is in the first floor, second floor, or third floor and all, it will be taxable under the head house property, guys. Okay, sir. Next, second note. If an assessee is engaged in the business of letting out of residential houses, as I already explained, the income will be taxable under the head house property. Yes, sir. Then the third one is notional income provisions are applicable under this head, guys. Very important. Even though the assessee might not have any income, still it will be taxable under this head. Especially, example is deemed to be let out property. Deemed to be let out property. Or else sometimes assessee might be showing actual rent only 1 lakh. But if expected rent is more than that, then he may end up paying tax on the higher figure. So that is why we call the notional income might be getting taxed under this head. Okay. Fine. We have few things with respect to notional income and all. Even, for example, if house property is held as a stock by the assessee and if it is not sold within 2 years, after 2 years, then it can be considered as deemed to be let out property, guys. We have that provision. We will see. Oh. So we have section 23, 24 and 25 which talks about the computation of income under the head house property. So for income tax purpose, the house property is divided into three categories, guys. First one, let out property. From let out property, we can have any amount of income or any amount of loss, guys. Okay. Then second one is self-occupied property. This is a property which is used by the assessee along with their family members for their self-occupation, or it can also be an unoccupied property. Assessee can maximum have two properties as self-occupied property, guys. This benefit is available only for individual and HUF. Okay. So what can be the income for this property? Either it will be nil or maximum loss of 30,000 or 2 lakh for self-occupied property. Got it? As the maximum property which can be held as self-occupied property is 2. It is covered under section 23 subsection 2. That is a shortcut. Then deemed to be let out property is covered under section 23 subsection 4. Deemed to be let out property start with a D and D is the fourth alphabet. So subsection 4, guys. Deemed to be let out property means as if it is let out. Actually it is not let out, but we will treat it as if it is let out. So even in that case, we can have any amount of income or loss, guys. Okay, sir. And what is the format to compute the income under the head house property is given in the law? We need to strictly follow the same, guys. So if it is a let out property, how to compute the income? It will start with gross annual value, guys. The format is actually same for both let out property or deemed to be let out property. Okay, first we need to derive gross annual value. How to calculate it? I will explain after this. So gross annual value of a property we need to take. Okay. And from that, local taxes or property tax or municipal tax paid by the owner during the previous year should be deducted, guys. Clear? It should be paid during the previous year by the owner. Sir, what if it is paid by the tenant? No deduction. Sir, what if it is not paid? It is accrued or it is due but not paid? No deduction. There is no deduction. Okay. Then we get net annual value. From net annual value, we can claim two deductions under section 24. First one is standard deduction, which is 30% of NAV. Whatever is the net annual value, 30% of that will be allowed as deduction, guys. Okay, sir. Then interest on housing loan payable. So if assessee has taken any housing loan for the construction or purchase, repairs, renovation and all, then whatever interest is paying will be allowed as deduction. But this is on accrual basis. Municipal tax or local tax will be allowed on payment basis, whereas interest is allowed on accrual basis. I have used the word payable, whereas here I have used the word paid. Please be careful. Okay, sir. Once we claim this deduction, whatever figure we get is called taxable income from house property. And this will be considered to compute total income of the assessee, guys. Okay. So to compute the income under the head house property, the starting point is gross annual value. How do we derive it, sir? I have given in the next page. Annual value or gross annual value, how do we calculate it? There is two separate part here, when there is no vacancy and when there is vacancy. So what is it? We will see. When there is no vacancy means the property of an assessee is let out for throughout the year. That is for all 12 months, the property is let out. Tenant is staying in the property. In that case, we need to compare first municipal value with fair rent and take whichever is higher in the first step. And once we get whichever is higher, I need to compare it with standard rent and take whichever is lower. And we call this as expected rent. And compare expected rent with actual rent and take whichever is higher. That would be called as gross annual value. And while calculating actual rent, what should we do is take annual rent, that is monthly rent into 12, minus if there is any unrealized rent. Sir, what is unrealized rent? Guys, tenant is staying in a property but is not paying rent to the owner. So that is nothing like a bad debt. Okay, it is similar to bad debt. Okay, sir. So when tenant is staying in a property but is not paying rent to the owner, then we treat it as unrealized rent. And can we deduct it? Yes. But unrealized rent can be deducted only if rule 4 conditions are satisfied. Under rule 4, there are 4 conditions. If all the conditions are satisfied, then unrealized rent can be deducted from annual rent to compute actual rent. Sir, what if rule 4 conditions are not satisfied? Then annual rents will straight away become actual rent, guys. Now, what are those conditions under rule 4, guys? So I will just take an help of my provision book. Okay, just a minute. Yes. Yeah, I've given you. What are the rule 4 conditions? The tenancy should be bona fide. Then the defaulting tenant as should have been vacated the property, and the owner should not allow him to occupy any other property in any other area. Okay, I should not ask you vacate this property, I will give you another property in different area. That should not happen. Then the assessee should have taken all the legal proceedings or all the legal steps in order to collect whatever money is due from the tenant. Or he has to prove that, sir, whatever I do, he will not pay, sir. It is waste of my time and energy. So if all these 4 conditions are satisfied, then unrealized rent can be reduced from the annual rent, guys. Okay, sir. Then, sir, what is this? Actual rent, okay. This is what the owner is earning from tenant. What about this, sir? Guys, municipal value is the value fixed by the municipal authorities for the payment of municipal tax. We also call it as government value. Then fair rent is a rent which a similar property in the same locality is fetching. Then the last one, that is standard rent. This is the maximum rent which an owner can charge to the tenant. So that is why we are taking whichever is lower here. Got it? Okay. So whatever we learned now was computation of gross annual value when there is no vacancy. Sir, what if there is a vacancy? Means property was vacant for 1 or more months during the previous year. For example, assume you were occupying my property and you vacated my property, and for 2 months I couldn't find a new tenant. After that, I found a new tenant. So for 2 months, my property was vacant. So whatever rent I was supposed to earn for 2 months, I lost it. No, yes, we call it as loss due to vacancy. So in this case, the assessee would be suffering a loss due to vacancy. So that is why there is a slight change in the gross annual value calculation, guys. So what is it? We will see. Where let out property is vacant for any part of the previous year. Any part of the previous year means it can be for few days or it can be for few months. Okay. In that case, till year it will remain same, guys. Till year it will remain same. Only this step will change. That is actual rent calculation. Okay. If expected rent is first calculate actual rent. Okay. First calculate actual rent. How do we calculate actual rent? Annual rent, that is monthly rent into 12 minus loss due to vacancy. In my example, I had a loss due to vacancy for 2 months. No, that is nothing but monthly rent into how many months the property was vacant. Okay. And if there is any unrealized rent also, you reduce it. And please be careful, unrealized rent is different from loss due to vacancy. Unrealized rent means tenant is staying in the property but is not paying rent. Whereas loss due to vacancy means, sir, there is no tenant in my property. Property is vacant. Okay, yes. So we will calculate actual rent. Fine. So expected rent, I need to compare it with actual rent plus loss due to vacancy. Sir, while calculating actual rent, you already reduced loss due to vacancy, no sir? Why again you are adding back? Guys, just for comparison purpose, because expected rent will be for full year. If I just take actual rent, then it can be for let out period. Okay, and if there is unrealized rent after that, yes, but there should be a common base to compare, right? Yes. So that is why we are just adding loss due to vacancy, but loss due to vacancy will not get taxed. Here only for comparison purpose we are adding back. Clear? So whatever we deducted here, we are just adding it here for comparison purpose. Okay, sir. Coming back to this. If expected rent is less than or equal to actual rent plus loss due to vacancy, then actual rent will be the GAV. Actual rent will be the GAV. Then, if expected rent is more than actual rent plus loss due to vacancy, then expected rent will be taken as gross annual value. Got it? Yes. Fine. So this notes I already taken care. We will move forward. So there are only 3 deductions while computing the income under the head house property. What are those guys? Municipal tax or property tax paid, then 30% of NAV, and the last one is interest on housing loan. Only 3 deductions. Okay. So for municipal tax or local tax or property tax, we don't have any dedicated section. Okay, but it is allowed only on payment basis provided it is paid by owner. If it is paid by tenant, then no deduction. Sir, what if municipal tax is not paid in the current year, but in the next year, for both the years it is paid. In the next year, you can claim whatever amount is being paid, including the municipal tax paid for the current year. So in the next year, On payment basis, whatever amount of municipal tax is paid can be claimed as deduction, guys. Yes, sir. Then deductions under section 24. There are two deductions. First one, 24A. 30% of net annual value is allowed as deduction, guys. And this is allowed for let out property as well as deemed to be let out property. Whereas for self-occupied property, gross annual value will always be nil. So there is no question of municipal tax deduction as well as 30% of NAV for self-occupied property. Okay. And all the expenses are covered here other than the municipal tax and interest on housing loan. There is no separate deduction allowed for an assessee for repairs, painting, insurance and all. Because sometimes in the question they will just give all these figures to confuse you. Depreciation, repairs, painting and all. Please don't provide any separate deduction for it. All those are a part of standard deduction, guys. Got it? Yes, sir. Then interest on borrowed capital is allowed as deduction under section 24B. This is the important adjustment under the house property, guys. Okay. So what is it, sir? Interest payable on the loan borrowed for the purpose of CA triple R. What is CA triple R? That is the construction, acquisition, repairs, renovation, reconstruction. If loan is taken by the assessee for any of this purpose, whatever interest is payable on such loan will be allowed on accrual basis. Sir, what if assessee is taken a fresh loan to repay the old loan? Old loan was taken to purchase or construct the house property. Now to repay that loan, because the interest rate is higher, he has taken a fresh loan. So from tomorrow, whatever interest is paid on fresh loan, will it be allowed here? Yes, it will be allowed, because it is taken to repay the old loan, and old loan was taken for the purpose of purchase or construction or even repairs, renovation of the house property, guys. Got it? Yes, sir. Then, sir, what if purchaser has not paid the purchase price fully, and if that amount is converted into loan by the seller and the purchaser is paying the amount along with interest, is that interest allowed as deduction under section 24? Yes, guys, it is allowed. That is, if the purchaser has not paid the purchase consideration immediately and if seller is charging any interest for it, then can we consider it as interest on loan? Yes, and it is allowed. Yes, it is allowed, guys. Okay, this is important. Last two. Interest relating to the year of completion of construction can be fully claimed in that year, irrespective of the date of completion of construction. And interest relating to pre-construction period will be allowed in 5 equal installments from the year in which construction is completed. So this is important adjustment. I will just try to explain this with an example, guys. Please observe, please observe. Assume I took 50 lakh loan at 10% per annum on 1st April 2020. That is the date of loan. Date of loan, guys. And for what purpose, sir? For construction of house property. And I completed the construction of house property. Date of completion of construction is 1st July 2024. First, let us divide pre-construction period and post-construction period. Guys, pre-construction period will always start from date of loan and it will end on, listen, 31st March, immediately preceding the date of completion of construction. So what is the 31st March immediately preceding this date is 31st March 2024. So the pre-construction period is from date of loan till 31st March. So totally it will be 4 years. Clear? And here I have taken the date of loan as 1st April. It need not be 1st April. Always. Clear? Yes. Whereas here, pre-construction period end date will always be 31st March. Okay, 31st March of which year, sir? Immediately preceding the date of completion of construction. And post-construction period will be from what date? Immediately next day. That is from 1st April 24, post-construction period will start. So, for this period, on or after the post-construction period beginning date, whatever interest is there will be allowed in the same year. Irrespective of the date of completion of construction, you can claim the interest for that year in the same year. Clear? So you can see for the previous year 24-25 and onwards, you can claim current year interest plus 1/5 of pre-construction period interest. 1/5 of pre-construction period interest. Now let us see, sir, what is the pre-construction period interest? So pre-construction period totally in my case is 4 years. So the interest comes to 20 lakh. Can I claim it in one shot? No. During this period, house property only was not there. So I would have not allowed a deduction for interest. But can I claim after this date? Yes, in 5 installments. So pre-construction period is this year's, which is totally 4 years, which comes to 20 lakh. 1/5 of that I can claim from the year 24-25. So for the first 5 years, I can claim current year interest plus 1/5 of pre-construction period interest. Whereas from 6th year, only current year interest if loan is still outstanding. Got it? Yes, guys. So please be careful. I repeat once again, pre-construction period will start from date of loan and it will end on 31st March, immediately preceding the date of completion of construction. Got it? Whereas post-construction period will start immediately from next day. So whatever interest is relating to post-construction period, you can claim it in the same year, irrespective of the date of completion of construction. Whereas whatever interest is relating to pre-construction period, you can claim it in 5 equal installments from the year in which construction is completed. Okay, sir. Now, coming to the interest. Sir, is there any restriction to claim interest deduction? So, yes, only for self-occupied property. If it is a let out property or deemed to be let out property, whatever is the amount of interest which is accrued, you can claim it full. Whereas if it is self-occupied property, maximum you can claim is 30,000 or 2 lakh per annum per person. Normally it is 30,000, but if the following conditions are satisfied, then assessee can claim 2 lakh. So what are those two conditions, sir? We will see. Only if both our condition has to be satisfied to claim 2 lakh interest. Okay, what is it? Property is constructed or purchased, so only CA, that is construction or acquisition, only both. Sir, what if it is repairs, renovation, reconstruction and all? Maximum 30,000. Maximum 30,000. Okay. So if property is constructed or purchased from a loan borrowed on or after 1st April 1999. Sir, what if loan is borrowed before that and we are still paying the interest, sir? Then maximum deduction is 30,000. Okay. Then such acquisition or construction is completed within 5 years from the end of financial year in which loan was borrowed. So the condition is like this. Please observe. Please observe. Sir, loan is taken on 1st April 2020, which is the end of that financial year, 31st March 2021. From there, within 5 years, construction has to be completed. If the loan is taken for construction, construction has to be completed within 5 years from the end of the year in which loan was borrowed. So while counting this 5 years, it is not from the date of loan. It is from the end of the financial year in which loan is borrowed. Got it? Yes, sir. So you will have time till when? So assume, I repeat, please listen now. Assume the loan was taken on 1st April 2020. So which is the end of that financial year, 31st March 2021. Okay. 5 years from here will end when? 31st March 26. So the assessee will have time to complete the construction on or before this date. If he has satisfied this condition along with the first condition, then he can claim maximum 2 lakh deduction for interest. For which property? Self-occupied. For self-occupied. Okay, guys. Sir, what if it is let out or deemed to be let out property? We don't care about all this. Straight away, whatever is the interest accrued, you can claim full. You can claim full, guys. Yes. So we'll see one by one properties. Self-occupied property or unoccupied property, which is covered in section 23 subsection 2. As I already told you guys, maximum an assessee can have how many self-occupied property? 2. So it is covered under section 23 subsection 2. Okay. So format is very simple. Guys, gross annual value or net annual value for self-occupied property will always be nil. So there is no deduction for municipal tax. There is no deduction that is under section 24A, that is standard deduction. Okay. So that means we need to focus only on interest on housing loan. And for self-occupied property, maximum interest allowed is 30,000 or subject to conditions, it is 2 lakh. 2 lakh. And sir, what if a person has two self-occupied property? Can he claim 2 plus 2? No, no, no. Both houses put together 2 lakh per person per annum. Clear? So if I have two self-occupied property, both the houses put together, I can claim maximum interest 2 lakh. Okay, sir. So from self-occupied property, the assessee will either have nil income, that is, if he doesn't have any loan and interest, he will have nil income, or if he has interest, then maximum he can have a loss of 30,000 or 2 lakh. Okay, sir. So interest on borrowed, loan borrowed shall not exceed 30,000 or 2 lakh. Clear? Yes, sir. And if the loan is borrowed for the purpose of repairs, renovation or reconstruction, then you are not eligible for 2 lakh. It is only 30,000. Got it? And as I already told you, maximum is 30,000 or 2 lakh. If a person is having more than one self-occupied property, that is assume two, both put together he can claim maximum 30,000 or 2 lakh. And the 2 lakh or 30,000 is including pre-construction period interest. So for the first 5 years, I told you, you can claim current year interest plus 1/5 of pre-construction period interest. No. Yes. If it is a self-occupied property, both put together, maximum 2 lakh. Both put together, maximum 2 lakh tax. Okay, sir. Then, property partly let out and partly self-occupied. Guys, if a single property is self-occupied for few months and let out for few months, then we will treat it as let out property for the entire year. And we will calculate the expected rent for the entire year and we will compare that with the actual rent for the let out period. And in such case, assessee is suffering a loss because, sir, definitely expected rent will be more than actual rent. So here also notional income is getting taxed. Yes, but we are also giving a benefit, that is municipal tax paid for the full year can be claimed along with interest also without any limit, as if it is a let out property. Even 30% of NAV also will be allowed as deduction. Got it? I repeat, if a single property is let out for few months and self-occupied for few months during the previous year, then it will be treated as let out property for the entire year. And we will compare expected rent for the whole year with actual rent for the let out period and take whichever is higher as GAV. And assessee can claim all the three deductions subject to conditions. Okay, sir. Then deemed to be let out property. Deemed to be let out property is covered under section 23 subsection 4, guys. When an individual or HUF owns more than two properties, maximum they can consider two properties as self-occupied and anything more than that will be treated as deemed to be let out property. Deemed to be let out property. And please be careful, the maximum two property which can be treated as self-occupied property is available only for individual and HUF. Sir, what if it is partnership firm or the company which is using the house properties for the residence of their partners or members or shareholders? Even in such case, it will be treated as deemed to be let out property, guys. So self-occupied property benefit is available only for individual and HUF. Now, who will decide? Now, assume I am an individual. I totally have 5 houses. All 5 houses is used for my self-occupation or for my family members. Then who will decide which two properties are self-occupied, which three properties are deemed to be let out property? I can decide it. I can decide it. So I can calculate the value for whichever property the expected rent or the gross annual value will be higher. I can treat them as the self-occupied property. Remaining three, I can offer it as deemed to be let out property. And in case of deemed to be let out property, the calculation is as if it is a let out property with only one change. What is that one change, sir? That one change is the actual rent will not be there for deemed to be let out property, guys. In that case, the expected rent itself will be taken as gross annual value. And deduction will be allowed for all the three as if it is a let out property. That is municipal tax paid by the owner during the previous year, then 30% of NAV as well as interest on housing loan. All the three deductions will be allowed. And interest on housing loan will be allowed without any restriction. Without any restriction, guys. Yes, sir. So just a minute. I will just show you the format which I have given you. Yeah. Come to page number 38, guys, where I have given the computation format. Just observe this. I have given the computation format for let out property, self-occupied property, as well as deemed to be let out property. So first, let us calculate gross annual value. How do we do it? We already discussed it. Pay attention, pay attention. Municipal value or fair rent, whichever is higher. Okay. Compare that with standard rent, whichever is lower. We call this as expected rent. Okay. Then for let out property, we will compare expected rent with actual rent and take whichever is higher as gross annual value. Whereas for deemed to be let out property, there is no question of actual rent because it is not at all let out. So straight away, what do? We take expected rent only as gross annual value. Whereas for self-occupied property, all this calculation will not come at all. Okay, sir. So whatever gross annual value we have calculated here, we will take it in the next step. Okay. Then municipal tax paid by the owner during the previous year is allowed as deduction only for let out property and deemed to be let out property, whereas here it is not allowed. Okay. Then we will get net annual value for self-occupied property. It will always be nil. Then deduction under section 24 is allowed for two things: 30% of NAV for let out and deemed to be let out property, and interest on housing loan. Interest on housing loan maximum for self-occupied property is 30,000 or 2 lakh, whereas for let out property and deemed to be let out property, whatever is the amount of interest which is accrued on accrual basis, guys. So finally we get income from house property. For self-occupied property, it will be either nil or loss, guys. It can never have positive figure. Yes, fine. Come back. Yes, we will continue with the other provisions. Notional income from house property held as stock in trade as per section 23 subsection 5. What is it? I will try to explain with this example. Assume, guys, Asasi is a Shobha developers who is engaged in the construction of properties. They construct flat. Assume they have constructed totally 100 flat in a area. Assume in Bangalore city. Now they have obtained completion certificate on 1st October 23. 1st October 23. That is in the financial year 23-24. We need to take the last day of that year. So the end of financial year in which the completion certificate is obtained is 31st March 2024. They have 2 years time to sell whatever flats they have constructed. Within that time, they have to sell it. So if they have not sold any property within this date, that is 2 years from the end of the financial year in which completion certificate is obtained, then after that, the unsold properties will be treated as deemed to be let out property, guys. So I have assumed here, assume 80 flats out of 100 is already sold before this date. That means whatever is the sale value of such flat will be taxable under the head PGBP, because for Shobha developer, flat is a stock. When they construct and sell it, and the sale value will be taxable under the head PGBP. Whereas 20 flats are unsold. They couldn't find a buyer within 31st March 2026. Then from 1st April 2026, that 20 unsold flats will be treated as deemed to be let out property, and expected rent of such 20 flats will be taxable under the head house property. Sir, in the future, if such flats are sold, then what, sir? Then the sale value will be taxable under the head PGBP, and it will not be treated as deemed to be let out property from the date of sale, guys. Got it? Yes. And you might also ask me, sir, what if actually property is let out? This 20 unsold flats is actually let out, sir. In that case, it will be treated as let out property. We will compare expected rent with actual rent and compute GAV. If it is remaining unsold and if it is not let out also, then we still treat it as deemed to be let out property, and expected rent will be taken as GAV, and we will compute the income from house property, guys. Even in such case, the notional income will be taxable in the hands of the assessee. Many real estate developer used to manipulate, so that is why the department or government has introduced this provisions, guys. Okay, let us move forward. Property let out partially. Guys, assume there is one property in which there are two units. One unit is let out, one unit is self-occupied. Then in that case, we need to treat each unit separately. We need to treat it as two separate houses, guys. Got it? Yes. So in such case, we need to compute the income separately. But please be careful. In such cases, many a times they will give municipal value, fair rent, standard rent and all for the entire property. So while calculating GAV, please divide it. Please divide it. Clear as per the area given in the question. Okay. And even the interest, property tax and all, they would have given it for the entire property. Please divide it between the units, guys. Okay. Then inadmissible deduction. If a loan is taken by an assessee from foreign country or from a foreign lender, and if he is paying interest, is interest allowed as a deduction under section 24B? Yes, it is allowed, provided interest is TDS is deducted on the interest. If assessee fails to deduct TDS on the interest which is paying to the foreign lender, then such interest will not be allowed as deduction, as per section 25. Then section 25A, which talks about arrears of rent or unrealized rent received subsequently. We have already understood what is unrealized rent. That is, sir, tenant stayed in my property, but he didn't pay me the rent. Or what is arrears of rent? That is, my owner increased the rent retrospectively from last year or last to last year. In that case, whatever is that enhanced part or increased part, he will be receiving in the current year relating to the past year. Will that be taxed in the year in which it is received by my owner? Yes. So, arrears of rent or unrealized rent received now will be taxable in the year in which it is received, even though in that year, if assessee is not the owner. Now assume I had unrealized rent relating to 2021, 1 lakh rupees. You were my tenant, you didn't pay me rent. You absconded. Okay. But in the current previous year, you came in search of me and gave 1 lakh rupees. Is that taxable under the head house property? Yes. But what if I had already sold this property? Still, whatever you paid me will be taxable under the head house property, because this is relating to the year in which I was the owner of the property. And I would have claimed this while calculating the actual rent in the year in which you absconded. You didn't pay me, no? Yes. I would have claimed the benefit. Yes. So when I realize it later, subsequently, it will be taxable under the head house property, guys. But subsection 2 is telling 30% flat deduction will be given in the year in which it is received. That means only 70% of what is received will be taxable under the head house property, guys. Got it? Yes. I will just give an example for this. Okay. Now assume in the year 21-22, I had let out my property. Monthly rent was 20,000, but for 2 months there was an unrealized rent that is coming to totally 40,000. So I had already claimed it in the year 21-22. While calculating the actual rent, I have deducted 40,000 unrealized rent. Now assume my tenant came and pay me this amount in the year 25-26. That is the current previous year. So I realized it. How much, sir? 40,000. So 30% of this will be allowed as standard deduction, but not under section 24. Now it is under section 25A subsection 2. Please be careful. This deduction is not under section 24A now. For unrealized rent received subsequently or arrears of rent received subsequently, 30% standard deduction is as per section 25A subsection 2, guys. Please be careful. Don't write wrong sections. So income from house property would be 28,000. Okay, sir. Second example. Assume, guys, monthly rent I was charging for my tenant 25,000 in the last year, previous year 24-25. But now I have increased the rent to 28,000 retrospectively from 1st April 2024. That is the beginning of last year. Beginning of last year. So in that case, in the current year, my owner will be receiving, okay, that is the owner of the property will be receiving 28,000 per month plus what is the difference for last year? 3,000. That is called arrears of rent. So 3,000 into 12 also you will be receiving in the current year arrears of rent relating to last year. But as the rent is increased retrospectively, last year tenant would have paid only 25,000. So in the current year, you will pay 28,000 for every month plus whatever is the shortage for last year, you will pay it now. How much is that? 3,000 into 12, which comes to 36,000. Even 30% of that will be allowed as standard deduction. So remaining is taxable, guys, as income from house property. Okay, sir. Then, sir, what about this income? Even this will be taxable. Okay, this we will calculate as usual. Normally, we will take this as actual rent, compare it with expected rent, and take as GAV, whichever is higher as GAV, and do the normal calculation. And whatever figure we get, for that we will add 25,200. Got it? Yes, sir. Fine. Next, section 26, which talks about co-ownership. So if an assessee jointly own the property along with anyone else, like brother, parents, spouse, or anyone else, in that case, how do we compute the income from house property? Guys, if it is a self-occupied property, we need to focus only on one thing. What is it? Interest. So if the assessee is a joint owner of the property along with others, then for each co-owner, deduction for interest is allowed of maximum 30,000, or if conditions are satisfied, 2 lakh. Now assume I co-own a property along with my brother. We have taken a loan for this house. What is the maximum interest allowed is 2 lakh for me, 2 lakh for my brother, each of them. Now assume along with this jointly owned property, I also own one property individual, which is self-occupied. So in that case, how much maximum deduction I can claim? For each property 2 lakh, but per person it is restricted to 2 lakh. Now as an individual, I can claim maximum 2 lakh deduction for interest for self-occupied property, guys. Both the houses put together. Got it? Yes, sir. Then, sir, what if jointly owned property is let out? In that case, we will compute the income from house property as if it is owned by one person. The final figure, whatever we derive, we will share it between the co-owners in the ratio of ownership. Clear? So we will compute all the items. We will compute the income, the final figure, as if the property is owned by one person, and that figure we will split it between the co-owners in the ratio of ownership, guys. Okay, sir. The last one, section 27, which talks about the deemed ownership. Guys, section 22 told the annual value of the property of which the assessee is the owner is taxable under this head. That means if I am not the owner of the property, then it is not taxable under this head. Yes, for example, I will just give one example. Assume, guys, I own a property which I have let out for you for a rent. Now, whatever you are paying me will be taxable in my hands under the head house property. Yes. Now, assume you are not staying in that property, you are subletting it to your friend. Now, whatever rental income you are earning, where is it taxable? Under the head other sources. Why? Because you are not the owner. So, whatever rent you are earning from subletting the property will be taxable in your hands under the head other sources. Okay. But there are few exceptions for actual legal ownership as per section 27, where legal owner might be some other person. But as per section 27, we are deeming someone else as deemed owner. And rental income will be taxable in the hands of deemed owner under the head income from house property, guys. So which are those cases? Totally we have 5. What are those? We will see. As per section 27, the following person, though not the legal owners of the property, are deemed to be the owners of for the purpose of section 22 to 26. So we will treat them as if they are the owner, and we will compute income from house property in their hands. So what are those? One by one. First case, transfer of house property to a spouse or minor child other than minor married daughter as a gift, that is without any consideration in return or for inadequate consideration. In such case, even though the receiver is legal owner, the transferor will be deemed to be the owner for income tax purpose. So I will just explain you. Assume an individual who is called transferor transfer the house property without consideration, that is free of cost, to a spouse or minor child, or even for inadequate consideration. For example, assume house property stamp duty value is 1 crore, whereas it is sold by individual to his spouse only for 50 lakh, 40 lakh. We call it as inadequate consideration. Okay, even in that case, section 27 will be applicable. Okay, sir. So the property is transferred by individual to a spouse or minor child other than minor married daughter. If it is transferred to minor married daughter, then deemed ownership is not applicable. Okay, sir. So actually this person is the legal owner. But for section 27, that is for income tax purpose, we are deeming this person as deemed owner, guys. And income from this house property, even though it is received by them, still it is taxable in the hands of the transferor. Got it? Yes. And there is one exception for it. That is, if an individual transfer money to a spouse or minor child, and if this person purchased the house property from this money, will section 27 be applicable? No. In that case, clubbing will get attracted as per section 64, whereas section 27 will not be attracted, guys. Because here what is transferred is money and not house property. So in such case, section 27 will not be applicable, but clubbing will be applicable. Whatever income this person is earning from such asset which is purchased from the money transferred by this individual will be clubbed in the hands of the transferor. Okay, sir. Next, holder of impartable estate. Example is like HUF. Now assume HUF is holding the assets on behalf of their members. So actually the owner is members, whereas HUF is managing it. In that case, whatever income earned from that asset will be taxable in the hands of HUF, guys. Next, member of cooperative society or company or other association. Now assume a property is owned by cooperative society and they have transferred it. Sorry, they have just given it for members to use it. They have not sold it. They have just allotted this property to the member to use it. In such case, even though the legal owner is cooperative society, still member will be considered as deemed owner who is enjoying the possession of the property. And any income from such property will be taxable in the hands of member. The next one, person who is enjoying the possession of a property. Assume I have purchased a property from you. I have already started enjoying the possession, but still property is not registered in my name. Property is still not yet registered in my name. So as per Transfer of Property Act, the person who is enjoying the possession will be considered as deemed owner. Same provision is taken under section 27, guys. So me as a buyer will be considered as deemed owner even though the property is still not yet registered in my name, guys. Or last one, person having a right in the property for a period not less than 12 years. So if I have taken any property for a lease, assume for 15 years, which is more than 12 years, then even though I am not the legal owner, still I will be considered to be deemed owner, and any income from such property will be taxable in my hands. Got it? Yes, sir. Fine. So this part is already done. Now coming to the treatment of house property loss. Guys, at the end of every head, I will also talk about the loss adjustment. Means if at all if assessee has a loss, how do we adjust it? Sir, then you didn't cover it at the end of salary head. Guys, assessee can never have a loss under the head salary. Because of assessee, the employer can suffer a loss, but there can be no possibility of having loss under the head salary. So assessee can have loss only under the four heads of income. That is house property, business or profession, capital gains, and income from other sources. And income from other sources also very less possibility, but possibility is there. Yes, sir. But see, actually speaking, under the head salary, income is taxable on due or receipt basis, whichever is earlier. Now assume I was working in a company for a salary of 1 lakh rupees per month. So salary was due. I have worked and salary was due for me. But my employer didn't pay salary for 3 months. Is it still taxable in my hands? Yes, I ended up paying tax on it. Clear? And I have worked for that, but I didn't receive it. So is it like a loss for me? Yes. But under income tax law, they are not allowing you to set off such 3 lakh loss. 3 lakh loss means 1 lakh rupees is per month into 3 months. Is that clear? So under income tax act, they are not considering it, guys. Clear? Yes. Sure. Let us come back to house property now. Now, if an assessee has a loss under the head house property, how can he adjust it? First, always we need to check whether it is a current year loss or brought forward loss. Assume assessee has a loss from house property in the current year. First, check whether you can set it off against the same head. So, if there is a loss from house property, it can be adjusted within the same head against the income from another house property without any limit. If that is not possible, then it can be adjusted against income from any other head of income, but maximum 2 lakh per year. Maximum 2 lakh per year, which we call it as interhead adjustment. Okay. Then, if this is also not possible, first intra. If that is not possible, we will go for inter. If that is also not possible, you can carry forward it for next 8 years. And when you carry forward, we will call it as brought forward loss in the subsequent year. You can adjust it only within the same head of income. When you carry forward the loss, inter-aid is not allowed, guys. Inter-aid will not be allowed. I repeat. When assessee has a loss under the head house property, first thing is adjust it within the same head against income from any other house property without any limit. If not possible, then you can adjust it against other heads of income, maximum 2 lakh per year. If that is also not possible, then carry forward it for next 8 years. And when you carry forward, you can adjust it only within the same head of income, that is the house property head. Okay, and maximum 8 years. Sir, what within 8 years I couldn't adjust that loss, then it will become lapse, guys. Okay, but if an assessee is following the default scheme under section 115 BAC, then this as well as this is not allowed. That means if I am an assessee who is following default scheme under section 115 BAC, and if I have a loss from house property, I can adjust it only within the same head in the same year. I cannot adjust it against other rates of income. I cannot carry forward it. And even if I have carry forward, I cannot adjust it against any income, including within the same head. Clear? I repeat, if I am an assessee who is following default scheme under section 115 BAC, only this option is available for me. That is, such loss can be adjusted only within the same head in the same year. Okay, sir. Then, Impact of section 115 BAC under this head, that is income from house property. So while computing the income under the head house property, what are not allowed or what is blocked for an assessee who is following default scheme? Yes, interest deduction of 30,000 or 2 lakh for self-occupied property is not allowed, guys. So we learned that for self-occupied property or unoccupied property, maximum interest allowed is 30,000 or 2 lakh, right? But that is blocked under default regime. That means if an assessee is following the default regime, income from self-occupied property will always be nil, guys. It will always be nil, nil, nil. Yes, sir. Then set off of current year house property loss against other rates. So can you adjust the house property loss against other rates? No, not possible. Then set off of brought forward house property losses against current year house property income. So, first of all, can you adjust the current year house property loss against other rates? No. Can you carry forward? No. Both is not possible. But there can be a scenario where, assume in the last year I was following optional scheme. I had a loss from house property which I couldn't adjust. Can I carry forward? Yes. As I was following optional scheme, I can carry forward. But this year, I am going for default scheme. So whatever I have carry forward, can I adjust it? No, sorry, you cannot adjust it, because as you have come under the default regime, you cannot adjust. You cannot adjust, guys. Okay, sir. So this is all about income from house property, guys. So we'll just mark the section in the first page. Come to the first page where I have given the list of sections, guys. Yes, sir. Yes. So in this chapter, we have covered section 22 to 27, and each and every section is a part of your syllabus, guys. So we are done.